Right, hello and welcome to the first episode of Can I Be a Stock Market Genius? I'm going to level with you right off the bat here, actually, because this channel is fully intended to be a live stream. The problem I have with that is that we're fast approaching the summer holidays, and I have children, and anybody with children is aware that if you were trying the live stream, you're probably going to get interrupted quite a lot. So at least for the initial few months, I would imagine the live stream is going to be put on hold, and we're just going to do this video format, which is fine. I'm still going to basically do exactly the same thing. The only thing that's going to be missing is the live interaction with people. It's a shame because this channel was built for me to learn from you effectively. It's an educational channel for myself. I don't know what I'm doing. I've put a disclaimer video out there before that you really should watch. It's quite fundamental that you watch it, really. I don't know what I'm doing. I've got no qualifications. I've got no previous investing experience. All I have done is I have read some books, I've watched some YouTube videos, I've listened to some podcasts. So basically, I am a complete novice when it comes to investing. But from reading the books and from what I have learned, I want to see whether or not I can beat the market, like the books tell you that you can. So from a advice perspective, none of it on this channel is advice. It is literally me sat here in front of my computer doing what I would be doing anyway and seeing whether or not I can create interactions with people who can tell me that I'm wrong. Fundamentally, I'm looking for people to tell me that I'm wrong because I'm not experienced. I don't really know what I'm doing. And I'm an engineer by trade, so I fundamentally believe that you learn from your mistakes. So not doing a live stream to start with is going to delay that, assuming that anybody is going to end up watching this at all anyway, which is probably unlikely. But I can still get the interaction in the comments from people, which is fine. It would just be a little while before I do a live stream, I believe. Eventually as well, I'll probably get a webcam for moments like this, where if anybody is watching it, currently they're just watching a screen stay still. At least if I was on webcam, there'd be something moving to pay attention to. But what I'm probably going to do is just start off talking about the tools that I use, and then we'd probably just launch straight into what I'm going to be doing anyway. That the whole point of me doing this is that I'm doing it anyway, so I might as well live stream it and see if I can connect with people who are on a similar journey to myself, or people that are way more experienced than myself, because they're the people really that I would like to learn from. And then if I can end up building a portfolio, because I've never built a portfolio before, but if I can end up building a portfolio and then all this works out and I can indeed beat the market, there'll be a blueprint for future people to see how it was done. So what I'm going to do to start with, I think, is just show you the tools that I use. I'm not going to lie to you, right? Straight off the bat as well. A lot of what I do, I've taken from Keith Gill, Roaring Kitty. If you want a better live stream, go and watch that. I've watched all of them, and he's quite knowledgeable, very knowledgeable. Obviously, did a very successful GameStop trade. If you're a value investor like I am, you've probably come across his work. So I actually use a lot of the same websites that he does, and I got them from his stream. So basically, stop watching that and go and watch his, I guess. But if not, we're going to build a portfolio together. But like I said, I use a lot of the same tools that he uses. I've got a spreadsheet as well that I've built, which is quite heavily influenced by his spreadsheet. It is just here. Let me find it. So this is my spreadsheet that I use. Some of the metrics that I find that I believe will be important to me, because like I said, I've not built a portfolio yet. I've built a spreadsheet, I've read some books, and this is where we are at. I also use another spreadsheet on top of this one. Once we start analyzing some stocks, we'll go into this in a bit more detail. But I also use what I call quick take spreadsheet, which is currently on this screen here. I'll just put it up there. So I use Wise Sheets data. It's pretty good. It's, as far as I've come across, the cheapest cheapest out there. That's got good data. You can pay a lot of money for data. This is a very good price, and the data is pretty sound on it. I've had a couple mistakes I found in the data. I've emailed them and they've rectified it. So from that perspective, very, very good. But this is a quick take spreadsheet. Now, difference between the two is that this is very minimal. This is things that I am wanting to see straight off the bat, and if I don't see them, then I'm probably not going to go any deeper into the company. So a lot of this is taken from Joel Greenblatt. It's his version, as you can see by this calculation here. It's his version of return on capital. I've watched the lectures that you can find online from Joel Greenblatt. There's about 6 of them, I believe, from Columbia. But I've also watched Lee Lu when he was with Bruce Greenwald. There's a video of that lecture on there as well on YouTube. It's very hard to find a lot of Lee Lu's stuff, so that's the only thing that I've come across. And he also is very big, at least in this initial lecture, the only lecture that I've found of his, he's very big on return on capital, the same as Joel Greenblatt. So it's a very, very similar calculation to work it out as well. So I'm looking at that. I'm looking at earnings yield, so operating earnings yields, EBIT. And I've also, because EBIT can be negative, but free cash flow can be positive. Obviously, EBIT, I'm aware, is unlevered, whereas free cash flow is, because it starts on net income. But so I've got basically return on capital using EBIT like that, like it says in this box here. And I've got return on capital where I use simple free cash flow. Now, this is drawn straight out of Wise Sheets. I don't use the same free cash flow calculation, because there's a couple other things that I will take out of it when it goes into my big spreadsheet. But as this is called, this is a quick take spreadsheet. So if I was to put a company in this, say, I was talking about Keith Gill, GameStop, it would draw the data in and then tell me initially whether or not that is worth looking into. So if it passes this loose quick screen, which is something I'm probably going to have off on another monitor. I've got several monitors, so you'll have to bear with me, because sometimes I'll forget the stuff isn't on the screen. But if it doesn't pass this initial loose screen where I'm happy with what I see, I'll likely just toss it aside. One of the big things I've learnt, and I've learnt this from Monish Babrai, another fantastic value investor, is that you've got to say no fast. Lee Lu said the same thing. Is one of the biggest things you've got to work on is saying no quickly. So this is what this is for. If I believe it's interesting, then I will dig deeper on my main spreadsheet. So I've heard Monish Babrai in one of his YouTube videos talking that he doesn't like investing in companies where he won't get his money back within about 3 years. So what I've got down here, which will help me decide whether or not to look into it, is that's missing years to turn B. Right. So what I've got down here is basically this is the yield. It's 1 divided by the yield, which should show me how many years it would take for the current earnings to purchase the whole company back. Now, you're going to say no to a lot of stuff looking at this if you're going on a 3-year return like Monish Babrai. Now, Lee Lu and Monish Pabrai, Joel Greenblatt, they all are of the opinion that you only need to find 2 or 3 decent stocks a year. So there will probably be an awful lot of no. Monish Pabrai said if it doesn't hit you over the head as why is this so cheap, what is wrong with it, then probably not a good investment. So this page here I will be dragging off onto another monitor, but if you want to see it again or want me to explain parts of it, then just say in the comments, eventually, say in the live stream, we'll be able to bring it back up. So that's what I'll do. I'll go through screens here. I'm also big on insider buy-in. So insider buy-in here, this is a current list of all US stocks, insider buy-in on Open Insider. Again, stolen from Roaring Kitty. Monish Pabrai said you've got to be unafraid to clone. Be a great cloner, So if you've come across someone and you know that it's worked for them, I don't see why you shouldn't be taking, influence from them. There's no shame in that. From what I see, if they're successful, surely that's the formula, So if I'm talking about these people and I'm copying these people, it's because I respect their opinions on what they've done. So like I said, a lot of these things, SEC, insider buy-in, Whale Wisdom, Seeking Alpha, FINRA, it's all come from somebody else. EBIT to EV, return on capital, it's all come from somebody else. But they're successful, so why not copy them? So this here is, like I said, currently listed the insider buy-in. And what I would do is go down through this list and see whether or not any of them take my fancy in the quick take spreadsheet. If they do, I will then, wrong page. If they do, I will then bring that data into this spreadsheet. GameStop's in it currently. What a way to start on the coattails of someone else, huh? The only problem I got is that I don't have the internet speed where I live to draw the data in like Keith Guild does. So I have to open Y Sheets up here. It's add on into Excel. I use quarterly data, so roll in 12 months, as you can see up here. So year. I draw the quarterly data in, and then what I would do is I will copy and paste it into one of these 3 here, which will then fill out this. I've tried building the spreadsheet, and you can do it. I've tried building a spreadsheet where I just put the ticker in once and it draws all the data in for me, so I don't have to dump it in myself. But I just don't have the internet speed where I live to be able to do that without massively impacting the screen. And then sometimes the internet speed won't draw it in at all because it takes so long to do it. So I found it's a lot easier to do copy and paste in, even if it looks a lot more amateurish. So that's the way that I do it. But Y Sheets is what I use. At the moment, I'd highly recommend it. Like I said, if I've had any issues, I've emailed them and they've rectified them. I can't fault it. You will come across data sometimes that is inaccurate, but if you contact them, then they will sort it out. So I can't fault it for the price. I can't remember what the price is, but compared to everything else, it's really good. I started off inputting the data myself into these spreadsheets, and I was analyzing 1, maybe 2 companies a day at best. And then if I was saying no to them, it sort of felt like you've just wasted your day. Whereas by drawing this data in and using the data that they provide, I've gone from being able to do 1 or 2 a day to a hell of a lot more. So my ability to say no has increased a lot more. So I'll pull it in quarterly, but I've got a spreadsheet here where it will drag it in annually, rolling 12 months. So I'll reference this page probably far more often than I reference the quarterly results. I've also got the cover sheet here where I put whatever we're working in, whatever we're valuing in. It will give me some rough estimates based on some metrics that we'll talk about later on when we get into it. Z double prime score, Monish Pabrai, like I said, big on him. So I believe this is from his book Dando Investor, the 7 questions that he will ask himself before he invests in a stock. So say I put Apple in here, like AAPL. Oh, there's too many A's. AAPL. It will change. It will tell me what sector they're in. The business, current share price, and then I will have to drag the data in manually through this over here, copy and paste it into there, and then we will have Apple's basically metrics all in here. Let's just put GME back in here a minute so I get the correct price, because $209. Live stream's going wrong already. Look, live stream video. I can edit this out then. Can't. 23.42. So why is that not updated? There's me. Oh, there it has now. This is what I mean. See, sometimes my internet's quite slow, so drag it in. Like I said, you can do it. That is what this quick take spreadsheet does. Drags it in. I'm not dragging in an awful lot. This is here is basically what I'm dragging in. So it doesn't take a large amount of time, as you can see. Just to drag in these small metrics is very fast, but to drag in the amount of data that I need, for my main spreadsheet, it just slows it down way too much. So some of the things that I love to see, good cash flow. It's got to be, Monish Pabrai, all of them, Li Lu. It's all about what the company can generate, especially against itself on return on capital. So I've got a few different metrics here, like the EBIT share, because that's pre-interest expense, pre-taxes. I want to see that, like the fundamental earnings of the business. I've also got the interest expense in there, per share. This is all on a per share basis. Net income, sort of earnings, and then we're going to break down into the cash flow statement. So the cash flow from operations, the simple free cash flow. I've got everything that I've done. I've tried to put very layman terms notes into it so that other people can pause it, read it, and just see what I am looking at, and hopefully the logic behind it. So I've got 2 different simple free cash flow ones there. Remember I said that I watched Bruce Greenwald's lecture where Li Lu spoke at it. So I've also read Bruce Greenwald's book, and this here is actually his version of simple free cash flow using what did he call it? Earnings power value. So using the earnings power value, I would just compare that to the simple free cash flow that I use, which is cash flow from operations minus maintenance capex. Well, maintenance capex, we're going to use purchase of property, plant and equipment. I also take away stock compensation as well, because much like Warren Buffett, I believe that to be an expense, and not something that I like to see a lot of, especially if a company's struggling. A lot of the stuff we're going to end up having a look at, I believe, is probably struggling companies, which is why I've got all my debt ratios here. Not all my debt ratios, but ones that I like. And I've also got some more down here as well. Just to cast a quick eye over. Now, I use ChatGPT, is it? ChatGPT? Yeah, quite often. And it's helped me. I've only started using it in recent weeks, but it's helped me because I can just type in and ask, explain GameStop's business model and how it generates cash. Now, ChatGPT will then tell me quite quickly, without me having to source it, what the what the business model is and how it breaks down its earnings. See, so I found this very helpful, and it's only something I've started using very recently. I know I'm saying a lot as well, so that was going to have to stop. But this is early. This is going to be a bit of a shit show. I don't know what I'm doing. I've not planned for any of this. We are literally just winging it as we go. And again, another after just saying about it. I've also got Roaring Kitty's net cash, which is just operating cash flow minus investing cash flow. And I've also got another one there, which is operating minus investing and financing. I've never really figured out why he uses that, but my guess is these are the only two parts of the cash flow statement, as it says in the note, that directly are related to production. Cash from financing comes from bank loans, bonds, bank borrowings, that sort of thing. So I'm guessing that's why he doesn't use it, because he's just trying to look at the actual production part of the business. I've then got my EV to EBIT, EBIT to EV, EBIT to market cap as well. I wasn't going to use market cap, but I downloaded Joel Greenblatt's Columbia Lecture Notes, where he had Richard Pizzina talk, and he's talking about Lear Corp in it. And he stated he states in that he's using it against market cap. Now I know Joel Greenblatt, if you've read his books, is big into his enterprise value, which is what I use mainly, because obviously the debt is a very real expense. So I've got that from EBIT, the operating income, and then I've got it on a simple free cash flow basis as well. And then here it will tell me year on year on year how many years it would take for those earnings to buy back the business at its current enterprise value or at its current market cap. I've also got here as well multiples for simple free cash flow to market cap and to EV. There will probably be a reasonable amount of multiple analysis in this. I found it quite helpful to see, basically, because a lot of Joel Greenblatt, if you've read his You Can Be a Stock Market Genius book, which is what obviously this video is based on, then you will know that he quite highly values multiple analysis, in that he'll compare it to other businesses, see what across a spectrum, what like the average like cash flow multiple for the sector is or whatever, and then he will apply that to his current business that he's analyzing to see whether or not it's undervalued. So I've got multiple analysis stuff down here as well. Down here is just the outright value of the market cap, enterprise value, book value, tangible book value. Going down into other things, when we get down to here, it's just a bit nonsense, really, that it's just other stuff that helps with the formulas further up here. I've also got some things here which I quite like to see down here, just quick take. To be honest, I don't really use this too much. So I will use this here, and going forwards I will use this, but it's not really something that I look at too often. If I see a lot of green up here, then it's a good thing. So I've got net present value calculator, so discounted cash flow calculator here as well, with a few different models on it. So this here is just a standard model, just the simple free cash flow, what discount I want, because I use simple free cash flow margin. So I will enter that in there, and then I will use enter it up here. A 7-year average or 3-year average, and then what percentage of that I want to use. And then at the moment, right, this will probably change, but at the moment I just assume no growth, because I feel like that's the most conservative thing to do. That's probably the wrong thing to do, and I hope that people will rectify everything that I'm doing wrong in the comment section, or eventually in the chat section. Then a discount rate. Now, I found learning about a discount rate quite difficult, in that I know Joel Greenblatt said that he's never used below 6. Now, this was something he said like probably 15, 20 years ago now, so that could have changed again. But I've read that Warren Buffett, and I've analysed Michael Burry's, a couple of Michael Burry's trades. One was Packard back in the day. Seth Klarman, another one. I think he's actually mentioned in the notes here. So they're saying for a discount rate that they want to use at least 3% above the 10-year Treasury yield. Like I said, it was his cat trade, Michael Burry's cat trade. He seems to have used it for. Now, I know other people tend to use a lot higher discount rates. I know Keith Gill used a lot higher discount rate when he was doing his GME analysis. This is something that I still want to learn because I don't really know how to choose an appropriate discount rate. I've literally just done 3% above the 10-year Treasury, which is something I have to keep checking up on. I don't even know if that's actually currently right, which is obviously not a good start for talking about this. But so currently I'm only using 3% above the current US 10-year Treasury rate. If I'm doing... No, it doesn't matter about that. Don't worry about that. Not for now. So then, it discounts it at this rate down here, and then it will tell me like the present value in 5 years, 10 years, and 20 years. Now, Joel Greenblatts stated that if you're trying to forecast any more than about 3 years, he said, 3 years into the future, then you're basically, after that, wasting your time, because past that, nobody knows. So I don't really know why I've gone as far. Mainly, I would just use 5 years at a maximum. I know I've got a Monish Pabrai one here as well, because he uses the year 10. He will sell the value of the business. This is from his Dan Investor book. He will sell the business for a cash flow multiple of year 10, or as I'm going to do year 5 as well. So I've done 5 years and 10 years. The reason in his book he does 10 years, but everything else I'm reading from Joel Greenblatt and the like is that 10 years is a long time, that you're not going to be able to forecast that accurately. It's a bit hoodoo. So I've done 5 years as well. I feel like it's a reasonable compromise to do that. So Monish Pabrai will get to year 10. The discounted cash flow in year 10, he will apply a multiple to it, and that's what he's selling the business for. And then that will add to all the sum of all the current cash flows before that. So I've done that, and then basically these answers here will come up and give me a per share price for the business up here, which obviously at the moment is telling me that GameStop is massively overvalued. Now, GameStop is not something I will ever touch on a short basis. I think it's become a classic stock. It's become very, very popular. I believe that it's because of that, because of what Keith Gill's done, it's probably going to survive reasonably long term, because I think that investors just won't let it die, because it was like a punch to the man, effectively. Like, I agree. I wholly agree that it was massively undervalued. So it's not me saying anything other than what a fantastic investment that was. For it to be $1 with the cash flows that it was generating, especially going into a console cycle, and the assets that it's had, I think was ludicrous. And the people that were shorting it to believe that it was going to go to nothing, it's very easy to say that in hindsight. Obviously, the trade worked out incredibly well for everybody that was involved in it. But yeah, anyway, off on a tangent there. So another thing that I like to do is you can track on Whale Wisdom. You can track other people's investments and what they are doing. So I will do that. Oh, there's Michael Burry there at Berkshire Hathaway. I will do that as well occasionally, just to see what other people are invested in. I will use this a lot when it comes to deep diving on a stock. I want to know who else is invested in it, whether or not I'm the only person that sees it, or other people that I respect see it as well. Yahoo Finance, just for quick looking, like I said, Seeking Alpha, to see what anybody else's opinions on the businesses will be. We've got Ticker here as well, if it loads. The thing with Whale Wisdom is it only shows US holdings, whereas ticker can show holdings abroad as well. Not always, but most of the time it will show foreign holdings as well. So that's the other reason I use ticker. Don't even know how I stumbled across that one, to be honest. So effectively, that's what we're going to be doing going forwards, is that I will go through all of this. I will just go down a list of insider buying. I will put it into my, where are we? There, quick take spreadsheet, see whether or not it's worth deep diving on it. And if so, we'll put it into the main spreadsheet here. We'll do some proper analysis on it. Now, when I say proper analysis, my inexperienced analysis, there will be a lot of things that I will miss. I will probably make some investments where, in hindsight, I will think, what the hell was I doing? Because I'm building the experience. But ultimately, like I said, I just want to see whether or not you can beat the market as a nobody. I'm an engineer by trade. I work on the railways. I fix trains. There's no experience of investing or financial experience in my family. This is something that I have solely picked up. And can the average Joe beat the market? Can they do it? And this is where we are at. So I hope going forwards to eventually become a live stream. But I also hope to show you the nitty-gritty, the ins and outs of somebody with no experience and very, very little knowledge, trying to build a portfolio from start to finish to see whether or not in the long term it can beat the market. That is the goal, and that is the goal of this live stream. So I think what we will just do for now is just go down through this internal insider buying list. I like to see a certain amount. As you can see, I've put 200k in there. If it's only a few thousand, like that's not somebody who's invested in the company. You know, you want to see somebody making some big, meaningful investments to show that they are with the shareholder and that they fundamentally believe that the company is something that's worth investing in. Now, the good thing about Open Insider is it will also show you a chart. This sort of thing, when you read a lot of value investing stuff, this sort of looking stock, not saying that anything other than the chart here, this is a sort of place where you're probably going to be able to find the best deals. If the chart looks like shit, you're probably going to be able to find something because everybody's bailing out of it. And sometimes there's overreactions with that. Now, whether or not this is a good company, I do not know. And like I said, nothing that you hear here is investment advice at all. Do not copy me at all. This is my learning experience, and I want you to tell me that I'm an idiot. That's the starting point, okay? So I've also got a UK spreadsheet, as you can see here. UK. That's on a different screen currently. The reason why I've got that is that we don't do quarterly earnings, so I've had to completely rebuild the spreadsheet for 6 monthly, biannual. Is that even the right word? I don't know. Twice a year releases, so every 6 months. So the US one draws quarterly, the UK one draws every data for every 6 months. So I've got two different ones. You can probably tell from my accent, I am English. I come from the UK, Southwest UK, because I sound like a farmer. We will probably get into some UK stocks at some point, but the majority of the stuff I'm currently looking at is in US markets, which is probably dumb considering every value investor out there says that the US markets are incredibly overvalued. But that is where we are at currently because I'm just learning. I'm building my experience, and the US markets I found tend to have the best available data. The SEC is a fantastic website. We don't have an equivalent of it in the UK, at least not that I've found, where you can just go type in a ticker and boom, everything is there in front of you. I wish we did have one. I think it would be beneficial to the UK economy to have something like that. And if it does exist, please tell me. But as far as I'm aware, we've only got Company's House, and that's a bit of a minefield to look around, I found. I'm sure if you know where you're going, it's perfect, but it's not as easy to use as the SEC website is. So what I'm going to do then, just straight off the bat, is I'm going to bring up this one. What was the ticker? I've forgotten it already. HELE. What I will do going forward is that I will move my quick take spreadsheets down on a different monitor, so you won't see them. If you do want to see them, then comment, or when we get to the live stream, just say in the chat and I'll bring them up and we can look at it. But as I'm only screen recording the one screen, having to constantly go backwards and forwards is just going to slow the time process down. So what I will do is I will take the quick takes spreadsheet and I will just drop it off the screen. I'll put HELE into it and we'll see what it comes back as. So what is it? Consumer defensive. Helen of Troy Limited provides various consumer products in the United States. The company operates through 3 segments: home and outdoor, health and wellness, and beauty. See, this is the thing as well. There's going to be a lot of people watching this where they're like, how do you not know that? I ain't heard of this business. I haven't heard of a lot of the businesses. So I've got to do more research than most to come to a conclusion of what the business actually does, which is where ChatGPT has helped me a lot. So home and outdoor segment offers food preparation tools, gadgets, storage containers, organization, coffee makers, grinders. Okay, we're not going to read all of that. Health and wellness segment provides thermometers, blood pressure monitors. So they've got quite a wide business here. The beauty segment offers grooming brushes, tools, decorative, hairstyles. Right. So first things first. In here, new chat. What is Helen of Troy LTD? Typing skills going to show me up. LTD's business model does. So if you're wondering why initially, straight off the bat, I am going to do a little bit of research into this company, it's because it's come back here to say that on a EBIT on an EBIT yield to the market cap, it's made enough EBIT in the last 12 months that the company could be bought back within about 3.2 years. Historically as well, the return on capital was very good. Anything, what do I do? So anything above 10 to 20 gives me a light green. A bright green, catch my attention, is 20 to 49, and anything above 50 comes up as blue. If you watch Lee Lu's speech at Bruce Greenwald's lecture, it basically says that he likes companies to have a 50% return on capital. He said they're the good businesses. So, you know, we're not always going to be able to find these good businesses. Maybe that's the difference between someone who's successful, is that he would literally only invest in those sorts of businesses. But, you know, bright green, that's good. I like that. And I like the fact that in just over 3 years, from a market caps perspective, because as you can see, the enterprise value, it's highly leveraged, this company. The enterprise value is, the market cap is telling me that from a market cap perspective, if you were to forget about the debt, which you cannot do, there's enough earnings currently to be able to buy that back. Now, earnings, operating income, looks like it has actually dropped off a cliff, but we will get to that. So I'll drag that back down there and we will read what ChatGPT is going to tell us. Global consumer products. Well, I've never heard of it, but designs, develops, markets, distributes wide portfolio of branded goods, primarily in 2 segments. So they're saying primarily 2 segments, and Y Sheets is saying 3. Okay. The company invests heavily in R&D and product development to introduce innovative offerings that reinforce brand strength. They hold own brands, Oxo, Hydrofast, Never. Okay, licensed brands such as Vicks, Braun, Revlon, paying royalties and meeting license obligations, omni-channel distribution, retail partners, e-commerce. Low capex. Manufacturing is outsourced primarily in China and Mexico for cost efficiency and flexibility. Shock. The internal organization focuses on design, marketing, brand building, supply chain coordination, keeping operating expenses relatively lower. Growth via acquisition. So we're going to find probably a lot of goodwill on the books here, which is probably not going to help the enterprise value as well. So we'll have a look into that and see where that comes from. Charlie Munger and all that, they say that debt is a killer. You know, Lilu, earnings per buy, you don't want to invest in companies with a lot of debt. Well, 460 market cap to 1.4 billion enterprise value. That is a highly levered company. So we'll look into that because you've got to decide whether or not that company is going to be able to survive. Howard Marks, I've seen him say that a lot fewer companies go bust than you think, but you've got to have a risk tolerance for it. Leverage mathematically is where a lot of the big gains can come from. I've got some bits I've highlighted from Joel Greenblatt's book, actually, or maybe I'll show you them one day, and I'll probably put together a reading list, actually, of everything that I've read. So if other people want to see what's got me to this point, they can. Everything that I've watched as well. I've watched a lot of Monish Pabrai. He's very, very giving with his information and his time on YouTube. All of Roaring Kitty's live streams, watched all of them. That's a lot of watching mine because most of them's 2 to 3 hours, but there's some nuggets in there that I found. I've watched all of Joel Greenblatt's lectures that are available on the internet, on YouTube. They're easy to find as well, so you can just YouTube them. Somebody's actually put together a playlist where he's put them all together, so you can literally just watch them back to back to back. Anyway, getting away from myself here, going off on a tangent. Back to Helena Troy, and basically from a debt perspective, this doesn't look good just from the quick take. In a minute, we'll drag the data into the main spreadsheet and we will have a look and see how bad it actually is. Growth from acquisition, though, is something that we need to look into, because if you don't know if you ever another book you need to read, then Stock Market Shenanigans, I think that's what it's called. I can't remember who it's by, but there's a whole section on there by growth by acquisition, where people invested a lot in these companies thinking that they were getting bigger and bigger and bigger, and all they were actually doing was loading up their debt and making their earnings look better by buying other companies, which eventually you're going to run out of things to do with that, and it's going to come back and bite you. That's why you've got to be very aware when we're investing in stuff like that. Focus initiatives like Project Pegasus, streamlining supply chain cost reductions and elevate for growth. So straight away from that, I would read that they are having problems effectively. Their costs are too high, too much in the supply chain, clearly, otherwise they wouldn't have mentioned it. The business is lean, low capital expenditure, strong cash flow, disciplined capital allocation. Okay, we can look into that, can't we? Revenue and profits, full year 2024, 1.9 billion, split roughly 55%. So effectively, you're close to 50-50 in those two. Gross margin, 46%, with operating margin near 10 to 14, indicative of brand and operational leverage. Company generates most revenue via product sales, both through wholesale and its own channels. Okay, so business model summary, multi-brand portfolio, asset-light design and sourcing. So they've probably got a lot of lease expenses then, possibly. I mean, we're guessing at the moment. We haven't got the details up. We'll get it in a second. Omnichannel sales, acquisition-led growth, adds scale and new market access through mergers and acquisitions, focused efficiency programs, increases margins, and boosts cash flows. Overall strategy, Helena Troy leverages brand equity, innovation, omnichannel presence while maintaining low overhead and generating steady cash flows. We want steady cash flows, right? That's what you want. You want predictable companies. They don't look very steady looking at that over there, but we'll pull it up. successful integration of acquisitions, maintaining brand relevance. Let me know if you like a deeper dive into any topic. This is another thing as well that ChatGPT is good for, is that you can literally just keep going. You can go down the rabbit hole, and if it can source the information, it will pull it out and give it to you. So I quite like that. One of the other things that I will do, the HELE, Helena Troy. So I've looked at this previously and put a red flag next to it, which means don't invest in it. So we will see. I'm a fundamental analyst, right? But Jesus, that's quite a come down. But for people to say that there's nothing in technical analysis, I agree and disagree with that. I am fundamental to the core effectively, but I do believe that there's enough people in technical analysis nowadays that it has some sort of meaning. So we've gone back to 2010 there, and there's obviously a price level where it's reacted several times. It became the ceiling twice, and then the floor 3 times, 4 times, maybe 5 before it went higher. Now we're 15 years into the future, and the price is held up in exactly the same area again. So same here, around about here. There you go, look. There you go. So to say that there's nothing in technical analysis, I don't necessarily agree. But it is not the be all and end all. Underlying of any business is its valuation, its finances. Underlying, that is it. But there's definitely something in technical analysis. Now, I've got to be honest, I was one of the fools that started off thinking you could do Forex. So I believe my technical analysis skills are all right, because that's where I started. And then I decided, you know what? It's basically a game of heads or tails, majoritively. And I wanted a more, I wouldn't say intelligent approach, because obviously there's people that trade Forex for a living and they do it very intelligently, but I wanted a more in-depth thing. So I moved over to stocks. Now, at the moment, we seem to have broken out of that. Now, if we were to just do some quick technical analysis here, drag that up there, along there. Not surprise me if price easily gets down to there. From a technical analysis perspective, past performance is not indicative of future results, but going back several years here, this is a weekly chart, we've got this. Now, away from the hoodoo side of this, and we'll get onto the financials of it. So, cover sheet, HELE, Helena Troy. So I've got a comps analysis thing here, but at the moment it's wrong, so we're going to ignore that. I will have it in the future. Well, I will do 3 comps. I've got a comp sheet here. And then we can compare it across the industry with at least 3 other companies that are in the same sector, industry, to help with the comparative analysis, which obviously is something that if you watch Joel Greenblatt's lecture, he wants people to do comps to say, and for you to be able to say why this is the best company out of all the companies that you've compared it against. But for now, I'm going to go in here, let type HELE, Helena Troy Limited comes up. We will get the data. We'll drag it in. I said this is a bit of a fart and about way to do it, but with my internet speed, it's the only way to do it. Bring the balance sheet in there, Helena Troy, and bring the cash flow in there, and go to, where are we? The main metric sheet, right? So gross margin is actually increasing even though revenues are decreasing. That's not bad. So hang on a minute. Where's the EV price on the quick take spreadsheet? Completely different to the one on the... Maybe my quick take spreadsheet is wrong. That's saying 1.44 billion. This is saying it doesn't have a high enterprise value. Interesting. Yeah, very interesting that. 956 million in debt. Let's have a look. Total debt, where are we? What's going on there? Something's not right there. Straight off the bat, I'd imagine something's not quite right in the data. Balance sheet I want. Where are we? Total debt. Really? Jumping around a lot. So, stuff like this when it comes up and it doesn't seem right. Go on this, SEC. I made it so I've got shortcuts to be able to bring it up. There we go. 10Q, interactive data. Let's have a look at the debt. Financial statement. If you want to figure out how to do that, Roaring Kitty's done a video on that, on how to make your, what do they call them, search engines, so you can search through websites quickly to get the data up. You'd be better off trying to watch that one than you would me trying to explain it, because I did it so long ago and I'm not tech savvy. So long-term debt, current maturities, 20 million. 20 million. Oh, there you go. So it does have a huge amount of debt. A lot of cash. So what is wrong on my spreadsheet? Straight off the bat, that some data is potentially wrong, which obviously does not look good for Y sheets, but it is rarer than not that stuff can be wrong. Let's see what we've got here then. There we go. There's no long-term debt. It didn't drag the long-term debt in. So if we got short-term debt, liabilities current maturity is 20. Is this the one? Yeah, 31st of the 5th, yes. So long-term debt of 850, 700. I'm just putting it into the data on the spreadsheet currently. Current maturity is there. Flat. And we've got an enterprise value that's more similar to the one over here. Still slightly different, but there we go. As you can see here, current maturity is a long-term debt, and then long-term debt excluding current maturity. So add them together, total debt. Separated the lease liabilities, but that's going to show up in the book value. That's why tangible book value is negative. Let's have a look to see how much goodwill is actually on there then. Look at this one, because this is the annual goodwill. Goodwill and intangible assets, 1.3 billion. That's a lot. That is a lot. Total assets, 2.6. So half, 50% of that is effectively intangible. Not really something I like to see, to be honest. There's a huge difference between tangible book value and... If you were using tangible book value as a very, very loose proxy for liquidation value, negative, because you can't sell. How do you sell goodwill and intangible asset? How do you sell the fact that you've overpaid for a business to somebody else? You can't. So liquidation value proxy, because it's not, because if you want to do true liquidation value, you're gonna have to go into it, go into the balance sheet properly. It's not a good starting point. But despite falling revenues, although they're, to be fair, they're more in line with what they were post-COVID, are you seeing a return to normal earnings? There you go, see, yeah. But gross margin's increasing, which is good. When revenues are going bad, you want to know that their cost control is still pretty good. So it's currently saying R&D margins are nothing, but ChatGPT have said that their R&D, they're quite heavy into it, so might be another bit of data wrong. Research and development, there you go, 0. Let's have a look. Yeah, got nothing on there. Have a look. Goes to financials. Tell you what, when you get to this stage, it's easier to do this. Open up the actual 10Q. F. Research. 0. And D. Then, okay. Let's see what Yahoo Finance says about that. Yearly financials. Expenses. So they've got no reason either. And Aussie. Up the top. Down the bottom, reserve, down the bottom. Okay. All right. ChatGPT might be off the mark with that one then. Back to it. Okay. R&D margins now 0. Net income margins, and net income is obviously negative. There. Oh, it's the first time in a long time it's been negative as well, annually. Let's cause that. Oh, simple free cash flow still high though. Cash flow from operations minus capex. Book value is high, but effectively useless with the amount of debt and tangible book value being low. Their return on capital awful over the last year. Historically good. Simple free cash flow good. Years to purchase less you're doing on cash flow basis. What is the simple free historic? 7 years, 7.49 present value. 7, which put 7. 3 years. So the reason why I'm doing 7 and 3 is that Richard Bozzino only, when talking about Lear, only said what is the operating margin he was talking about at the time. Operating margin compared to previous years. Now, he only basically said the last 3 years when he was doing his analysis. Now, my take from that is that he's probably doing it so he's using the most recent, most relevant data. And if you go back further than that, you're starting to get into what potentially at that point could be a company that was not recognizable to itself. So that's why I'm using 2. So 8.7. Oh, so it's taking it straight from it. 3 year simple free cash flow margin. How have I done that then? Oh, well, I could get that to. All right, let's do that quickly. Seeing the spreadsheet be repaired in real time because it can take it for me. Where's 7 years? What does that go up to? 3, 4, 5, 6, 7 L. L. There we go. Now it's going to autofill that for me. It's one less job I have to do. Look, right there. Cash flow multiple. What does it normally trade for then, historically? Not a lot. Does it? Not a lot. So, mode for Bryce being here, there's no way it sell 15 because historically, nothing, you know. 2, 3, what's the average? 2. So I reckon we're just about to find out this company is very overvalued. We've got to have a look into the cash flows and why they've lost such a huge amount of earnings, net income to be negative. Something's happening there. I don't know. I put operating income. Oh, that to be honest, but it is. Their book value is effectively worthless when you've got goodwill and intangible assets that high. Current ratios were good though, so at least for the next year, they're still going to be around. Ability to pay off short-term debt. Company should have at least $2 of assets for every. This is from Benjamin Graham, right? As it says there, more of an old school opinion. Most companies won't carry a 2-to-1 ratio, but higher is better. You want to know that their short-term income can pay their short-term obligations, right? Effectively. Cash minus debt, that shows you how much debt they got. Look, compared to cash, minus $36 per share. No dividends. EBIT's negative. Cash flow from operations positive. Let's have a look, shall we? Where you want to start, really, the financial condition of the company. This is what I've learned. You want to start on the balance sheet. Said the goodwill intangible assets is not good. The level of it. It depends when the debt matures, I guess. We can have a look on that. I don't like that FINRA's changed from the Roaring Kitty era of FINRA. You should be able to just put in a ticker and it would show up. A lot of the time now it doesn't do that. 0, see, so you have to do, see if that comes up. We're going to be a right mishmash. So we'll go into the notes on the financial statement. Probably they should have gone there in the first place, to be honest. Property, plant and equipment, 323 million. The debt is huge though, isn't it? We find out what's going on. Goodwill and intangibles, what have they got there? Annual impairment testing, any future write-down. Impairment charges of 414 million. Jesus. That means that they've made acquisitions in businesses that are not performing well enough to justify the price. So is goodwill actually that much lower than what it was last year? Yes, significantly lower. Effectively, as Warren Kitty said, goodwill, future write-down, bad acquisition, effectively. Not, they've paid too much for it. So yeah, bad acquisition, I guess. Sorry, I'm just having a drink a minute. So another thing that I've noticed as well is that Michael Burry, Keith Gill, Warren Kitty, they don't like operating leases on the balance sheet. They preferred it pre, what is it, IFRS 16, I think it was. As it's a cost of sales, effectively, not a true debt. True debt can't be cancelled, whereas you can get out of leases, I guess, and that's the argument. So they don't see it as true debt and don't believe that it should be counted as true debt, which, to be honest, is probably the camp that I'm falling into as well. If you close a store, you lose the if you close a store, you lose the rent payment effectively. You just cease to pay it, so it's gone. My doorbell's going a minute. I will be right back. And we're back. Sorry, the doorbell went there, so that would have messed up a live stream as well. Yeah, so just talking about operating leases there, weren't we? I said I'm probably falling into the camp as well that not really a true debt, but there we go. I've lost my train of thought now. So what were we looking at? And what the debt was. In long-term revolver, term loans, total borrowing and a credit agreement. Summary of our long-term. So, stories. Credit agreement with Bank of America. Other lenders, aggregate 1.5 billion. So that's the revolving credit facility. 1 billion revolving. Okay. $457 million under the revolver, 250 million under the term loan. Utilize the proceeds to repay all debt outstanding for our prior credit agreement during the first quarter of fiscal 2026. Borrow 250 million under the delayed draw term loan facility and utilize the proceeds to repay outstanding on the revolving credit facility. Be honest, right? If we're thinking about it, probably should have said no to this already, because Monish Pabrai said if it doesn't hit you over the head, then it's not right. For the purpose of this video, probably see it through. I mean, it's not. It doesn't look like bad debt, does it? It just looks like a revolver. But are they earning enough to be able to pay that debt down? Is the question. What happened as well to the recurring fair value, note fair value, debt covenants? We're in compliance with all covenants defined under the terms of the credit agreement. Liabilities, interest rate swaps, contingent consideration, foreign currency derivative. What's happened then to gone wrong there? Profit, SG&A expenses are less. Impairment, that's what's killed them. So that's why they took a charge on impairment. So the goodwill's been wrote down, and that is why their earnings, their operating earnings have tanked compared to the free cash flow. Because if we go to the cash flow statement, that's not actually money that they've lost this year, is it? So asset impairment charges immediately added straight back in. 296,000 in stock comp, so not something I really like to see, but it is what it is. Not a lot, is it? Let's be honest. The 58 million in free cash flow, so it's actually considerably higher than previous year. And the net income's only been hammered because of the impairment charge by the look of it. So why is the stock taking an absolute beating from that? Interesting. Are they lease heavy? Didn't look like it, did it? 41 million non-current liability. They own most of their properties. Why don't we, instead of trying to figure out do they own or ChatGPT, tell us. Mixed property strategy owns key strategic facilities while leasing many others, mainly for flexibility and cost efficiency. What they owns a total of 41 properties worldwide as of 2018, though, so that is not up to date. 236. Yeah, we can see, we've seen that. Leased numerous facilities. 2024. Okay. Bottom line, Helen of Troy owns several high-value long-term sites critical to its operations while leasing other facilities and assets. All right, so we're learning. We are learning. So is there a reason for when was the impairment charge? I mean, they've been losing value for a long time. Let's not kid ourselves here. When did that spike? 2018. That's COVID there, I bet. There you go, March 2020. Through the roof on COVID, but now we're really low down here. Helen of Troy executives make significant share purchases. Have two of them sign into this. Okay, sign in. Can't remember my password now, so it'd be embarrassing if we can't get on it for the stream. Wrong password. Wrong password. This is going to be embarrassing. Not going to be able to log in the Whale Wisdom stream video. Not streaming yet. What is going on here then? There we go, we're in. We are in. So get that to go back up in Whale Wisdom. And after HELE. Helen of Troy, who's own it? Who owns it? There we go. So Medina Value Partners own 5.8, so about 6% of their account is in this. So that's a reasonable level of fiction, and they are in it as well. Look, blooming hell. 22, they're blooming very down on that. Anybody else worth Medina in it? But nothing, negligible, not worth even mentioning. So they own the most part of their portfolio. Who has got the highest ownership? BlackRock, Vanguard, State Street. Okay. Nobody. Athena owns 3.3% of it. Interesting. See inside of buying like then overall, just these two. Okay. That's the last 2 years as well. I do 4. Did anything? Sale. Blooming advert. That's not going to look good on a live stream, is it? Still going? Yeah, can't cancel it. All right. Let's get the spreadsheet back up. Look at this. Oh, down here a minute. What's the free cash flow like year on year? 1.3. Interesting. It's only trading at what, 4 times free cash flow? No, hang on. 5 share, what is it? 20. Market cap, yeah, 3.5 times. Now you've got a huge amount of debt in the revolver. You've got negative tangible book because the goodwill is probably going to get written down again and again and again. Then you're going to end up with negative book value. Cash coming into the company isn't actually that bad, is it? I remember if COVID was still hungover then, probably. Interesting. What about, so I've got a working capital analysis thing here, but I've got no receivables in there, so we've got to change that. Payables have dropped. What's the average of payables over the last, since COVID? 84 days. So inventory staying on the shelf longer than the last few years, though. And why is that 0? BSB 10. Net receivables, that's missing. Let's put that back in. Really, you're gonna make me do it again? I'm not watching it, see? Okay, what I'll do, drag it down there, get it playing on another screen, then they can't moan. Oh, it's in receivables, isn't it? Any fault now on the balance sheet, right? Receivable 314. Bring that back up here now. Yeah, 314814. Right, let's put that in the spreadsheet. 314814. Done. Now, people's paying them slightly quicker. Inventory staying on the shelf longer. Payables, it ain't out of line, is it? So nothing's, what that's effectively showing is that there's no like dodgy accounting going on, like extending payables or anything to make the debt harder to make it miss this financial statement effectively, so it doesn't show up in this one. Is that how it works? I don't know. Right, so 3 times cash flow, eh? No dividends by the look of it. All right. What has tanked them then? Is it literally just that impairment charge? Oh yeah, what I wanted to see was when it came in this quarter. Yeah, I'm in this quarter, so I don't know. Are we looking at an overstep of the market, or the fact that the balance sheet is no good, effectively no good, because there's so much goodwill on the books? When did it say the revolver was due? Goodwill and intangibles. So we looked at that one already, didn't we? Long-term debt. Revolving loan. When does it say it's due? August 15th, 2025. So this year. We're 250 million under the deal in the first quarter of fiscal 2026. Or 250 million under the delayed draw term loan facility and utilize proceeds to repay debt outstanding on a revolving credit facility. So they're borrowing to pay off the revolver, opposed to being able to do it through their own cash flow, is what I take from that. Am I wrong? You have to tell me in the comments if anybody watches it. What is anybody else saying on this? Beacon Alpha, HELE. Sell in July as well. Strong buy in July. All right, let's have a look at both. Sell rate and Helen of Troy with a fair value of 19 per share due to significant near-term risks. Company faces major headwinds from tariff uncertainty, weak consumer demand, heavy reliance on large retailers, limiting its pricing power. Highly leveraged balance sheet, yeah, which is declining margins and poor cash flow generation. We see in that. Have a look. Gross margin, declining. Yeah, it is. You're right. SG&A margin declining. You're right. Are they out of step with historically? COVID, average 31, average 44. These are buggered from the impairment charge. It's interesting, this one. Probably a reasonable one to start on, actually, because at least we're having a bit of a dive on it. Yeah, interesting. I don't like the goodwill at all. The past is anything to go by, it's going to get written off, isn't it? 16%, which is actually an increase on last year. Way down on the year before and way down historically. That's obviously the year they got hit by COVID, I'd imagine the next year, isn't it? Maybe finding their feet that year, I don't know. But it's not that bad compared to, we know what it is that's hit them, you know. Their earnings are not actually tanked, have they? The impairment charges hit them. Anyway, let's carry on. Read highly leveraged balance sheet, declining margins, poor cash generation. Yeah, read that. Several known brands: Osprey, Oxo, Hydro Flask, Vicks, Braun, Cross Beauty and Wellness, home and outdoor markets. I think the company faces significant risk from tariff uncertainty with limited ability to mitigate these additional costs. I'm initiating with a sell rating with a fair value of $19 per share, which is what, $3 lower than what we're at. Detailed in the table below, Helen of Troy manufactures a broad range of home beauty products. The company relies on Amazon, Walmart, and Target to distribute its products, with sales to the top 5 customers account for almost half of its total revenue, as noted in its 10K. As a result, the company heavily relies on large retailers and has limited pricing negotiation power. Yeah, there's probably some truth to that. Depicted in the chart below, as around 35% of its products are manufactured in China. The company's been significantly impacted by the tariff. Yeah, while the company plans to reduce the manufacturing footprint in China over the next 2 years, I think the company has insufficient mitigation measures to overcome the tariff-associated costs in the near term. Yeah. Now, this is where the question comes in, doesn't it? Are you an investor or are you a trader? You know, if you're an investor, sort of look beyond the current uncertainty, right? You're going to look at the business, you're going to look at what it returns on itself historically. I get it, right? This is a very near-term view, clearly. Over the next 2 years, so Helen of Troy releases its Q1 F26 full year 26 results on just July the 10th. So it's just done it. So I haven't got the updated data yet. Fine. Posting 70% organic revenue decline as depicted in the chart below. The management estimates that tariff-related impacts contributed around 8% to its revenue decline. So what was the rest? As such, the company has experienced challenges from both tariff duties as well as weekend market demands. Indeed, Helen of Troy's business has been falling in recent quarters. CEOs left, effective immediately. Brian Grass was promoted from CFO to interim CEO. So is that the geezer that's bought the... Yes, it is. Now, Has he bought it because he thinks it's cheap, or has he bought it because he thinks he has to? $96 he bought that in May. Was it $96 in May? Wait, free, idiot. Well, he's not sold according to this, has he? He's still in it. Still in it for 15,000 shares there. Where were we? Company exited the quarter with a total debt of 871 million, which is even higher than its current market capitalization. It's true. Company spent more than 100 million on share repurchases in 2025 with rising debts. Considering the company's sluggish growth, I think the management share repurchase decision does not make any sense. Well, if they are buying for less than the intrinsic value, then it does make sense. If they bought for over intrinsic value, you should be annoyed, right? Share count has dropped. So, yeah. I mean, they haven't bought back a lot, have they? But they have bought back some. The high debt level will pose significant difficulties for the company to invest in its global supply chain and new product categories. Helena Troy products fall within the consumer discretionary category. Its sales growth is tied to the overall consumer confidence to a large extent. Yeah. Considering the current weak macro environment, I don't anticipate that Helena Troy could recover its business anytime soon. So, again, another thing here. Monish Pabrai, Lilu, Charlie Munger, Warren Buffett, they don't focus on the macro because they can't influence it. They haven't got a clue what's going to happen. The government doesn't even know what's going to happen. War could break out tomorrow and it could ruin all of it, which would affect obviously the lower level of it as well. But this is a big, big picture view. Whereas from my experience of reading about the investors that I have done, that they don't care about the macro because they can't influence it. As depicted in the slide below, the company has a long list of reasons for its weak revenue growth this quarter, including order cancellations, a slowdown in retailer sales, competition, soft market demand, and slower replenishment seasons. The company is guiding for an 8.9 to 40% revenue decline with significant margin contraction for upcoming quarter, as shown in the slideshow. Right. But yes. Net sales 408 to 432, decline 14 to outdoor. High-level assumptions, continued headwinds from the evolving global tariff policies and related businesses and macroeconomic uncertainties, including forced cancellation of direct import orders in response to higher tariffs, consumer demand and increased competition. Okay. Interest expense in a range of 13 to 14 million. What was their free cash flow? 131 million. So interest coverage ratio 2.4. That's based off of interest expense on. We're looking. Total income expense there 14. So that there's 60. Any interest expense. Million. In short, I think the company faces too many near-term challenges in its leveraged balance sheet, declining margin profile, and poor cash flow generation could expose its shareholders to substantial downside risks. Considering all these headwinds, I project the company's revenue will decline by 10%, assuming an 8% impact from tariffs and 2% due to weak consumption. While the company tries to adjust to its global supply chain and reduce its reliance on China's manufacturing, this transition will take several years. As such, I don't anticipate any revenue growth in 2027, followed by 3% normalized revenue growth from 2028 onwards. So we're already getting into Joel Greenblatts voodoo territory, because it's difficult to know that far ahead. On the margin side, tariffs and operating leverage will be the two main headwinds, projected a 10 BPS annual margin contraction due to its weak pricing power over its distributors. If it is relying that much on that, then yes, there is going to be, weak pricing power. Calculated normalized operating costs will grow by 3.1%. He's showing it. That's good. Weighted average cost of capital is calculated to be 9.9%, risk 4.2%. So this is where I'd start losing interest, to be honest. Weighted average cost of capital. You're assuming what people want, from their equity return when it gets to that. Discount all future can have fair values to be $19. Right, we'll have a look. Upside risk, I assign Helen of Troy limited stock sell rating. I will discuss any potential upside catalyst for its share price. While the company has a high level of debt, it remains generating positive free cash flow. Yes, with a light financial structure. Yes. Over the past 3 years, the company's generated a total of $385 million free cash flow while spending $375 million in acquisitions. That's the problem. The acquisitions, because they're not doing them well. If you've lost, $400 million in goodwill this year, your acquisitions are dicey. M&A to enhance its portfolio and divest some underperforming brands and assets. Has to use it, potentially, yeah. In December 24, the company completed an acquisition of Olive & June omnichannel nail care brand for $229.4 million. It's encouraging to see the company acquire small brands to enhance its personal care portfolio. However, I anticipate the new management team to actively divest some non-core, low-growth product lines in the near future. Right. Management noted that its direct-to-consumer channel experienced 9% year-over-year growth. Okay. Right. Highly leveraged balance sheet. That's the problem. That is a problem. All right. And the other side of the fence, because this is a strong buy. Both Q1 earnings miss and tariff chaos have driven extreme pessimism, but it does look like there's extreme pessimism. Business remains cash flow positive and operationally resilient. Management is actively reducing China's exposure. Insiders are buying. That is true. Technical indicators suggest capitulation. Support my contrarian strong buy rating in the low 20. Okay. The market is ignoring Helen's global sourcing flexibility and manageable debt, with earnings rebound to $5 a share in 2026 from a cycle low. Yeah, 15% plus for earnings, free cash flow yield, deep value multiples, offers rare asymmetric upside for investors willing to buy when the market sentiment is darkest. It's definitely. Where am I? And the last is $500 million in simple free cash flow, 5 years. What's the simple free cash flow margin average? Got it in there, haven't we? So what are we going to say? So they're saying it's going to drop, revenues are going to drop considerably. So why don't we pardon my language, why don't we say revenues drop to 1.5 billion. That's pretty decent, isn't it? No. There's some fluctuation in it, but not. I'm guessing 2020 was a big acquisition, was it? Let's have a look. 22. acquisition. Is $28 a share. Over the next 5 years, going to generate $28 a share. On the basis that it's going to have to keep. Right. That alarm means I've got to go, unfortunately. I will come back tomorrow and we will continue looking at this because it looks a bit more than meets the eye, doesn't it? Historically, though, to be fair, right? Historically, average free cash flow 10 years, 1.7, currently 3.5. Needs to eat it. 1. So that would suggest over 5 years, it's only just undervalued. So we'll come back, we'll have a look tomorrow. Possibly, I might come back in a bit. After doing the school run, that's what the alarm was for. And I may have moved on come tomorrow. But so far, you've seen my process. We've done a semi-reasonable dive. Still very little understanding of the business, I will admit. Into Helen of Troy. This is my process. This is how I do it. I imagine it was boring as hell, to be honest. I'm not particularly up together with this so far. And it's more difficult when you've got no one to talk to. I'm literally basically talking to myself and assuming, or talking out loud, putting my thoughts out loud. And hopefully from this as well, you've determined that I know bugger all and you won't copy me. Because as I said at the start, this whole process is from my learning and people to teach me through my live streams and hopefully interacting with like-minded people. Anyway, right, I got to shoot. If you have watched, thank you very much for making it to the end. I promise you it will get better. This is my first stream. I haven't got a clue what I'm doing. I winged it. I had no plan, which was probably not good. But this is what I'm doing. This is what I'll be doing anyway. So I just thought I'll live stream it and hopefully be able to come across some people that I can talk to about investing, you know, people with like-minded opinions on things and hopefully people with the opposite opinion as well. So you need to be able to look at this from both sides of the fence, you know. We've probably wasted too much time on this company. It's not great historically looking at it on the multiples, but I'll have another look. If I find anything worth talking about, I'll put it in the next video. And we'll see. Anyway, thank you very much for watching. First video down. Probably going to listen back and think that it was awful, but I will get better, I promise. And the last thing to leave it on is do not copy me. Yeah, this video will probably show that I have no idea what I'm doing when I watch it back, which is good because then you will see my level of learning hopefully increase as the videos go along. So I'm going to leave it there. Thank you very much for watching. If you want to see more, like and subscribe. That's it. Appreciate it. Thank you very much. Goodbye.